Thank you everyone for having me here. Yes, so growing importance of climate risk and credit assessments, that's something we are really able to assess to with our climate risk assessment or climate risk analytics tool. So basically financial institutions and regulators are increasingly recognizing climate related risks, both physical and transition risks, as material factors influencing your credit risks. And climate risk can impact borrowers' ability to repay loans due to, let's say, physical risk. That example is, let's say, floods, wildfires, damaging assets, and transition risks where the policy changes, carbon pricing, for example, affecting high emission industries. And also there is a reputational and regulatory risks. Example, stricter ESG compliance requirements and mandates introduced by different jurisdictions, either globally or the local versions of it. Then regulatory bodies like the ECB, FED, and Basel Committee are pushing for climate stress testing and disclosure frameworks, example TCFD, SFDR, to ensure financial stability. There are challenges in integrating climate risks and credit risk models. Let me explain it with an example. So traditional credit risk models lack climate risk variables, leading to gaps in risk assessments. Some of the key challenges may include, data scarcity, where lack of historical climate-linked financial data leads to such scarcity basically. And then there are scenario, uncertainty, where varied climate pathways under different policy scenarios are to be undertaken. And there are methodological complexities, as well. That is what I mean by methodological complexity would be quantifying long-term climate impacts on short-term credit decisions. Then, obviously, we are also looking at how climate risk analytics, our software solutions, are addressing these problems that I just highlighted in terms of the challenges. So first of all, I would say specialized climate risk analytics platforms the platform that we provide. And there are, of course, other players in market who have solutions that address these problems. Without taking any names, but obviously there are, which sort of integrates climate risk into climate credit risk frameworks by climate data aggregation, scenario analysis and stress testing, ESG scoring and risk, heat maps, regulatory compliance, portfolio decarbonization tools. All these integration requirements are addressed ably by climate risk analytics. While there are players in market who are able to do these, where you may not be able to find is a unified platform that provides all these solutions as a one-stop shop solution, right? So we have an integrated solution that does not only look at, for example, risk modeling, climate risk modeling, but we are also having a solution that does disclosures. It helps different use cases from your RMs to CRO teams to CFO teams, etc. Even doing the portfolio rebalancing and in some stages strategizing for your future needs, as in where exactly you want to invest going forward, given your sustainability targets and goals that you might have set. Climate risk analytics is able to actually provide you all those solutions besides the credit risk management that which is the focus of our discussion is on today. Perhaps there are some of the benefits that I'd like to highlight what climate risk analytics is able to provide. Improved risk pricing, so that is climate adjusted probability of default models that we have inbuilt within the system, for which the data is sort of fetched from an open source data sets. Providers like Climate Trackers, ourworldindata.com, and a few other solutions wherein we fetch data from these open sources, more reliable because these are produced by some governing bodies, free of cost. So there's no data cost involved in the overall solution framework. Then there are early warning signals for vulnerable borrowers based on the credit risk model that we provide out of box. as mentioned in our improved risk pricing. And then there is enhanced regulatory reporting for investor transparency. And we are also able to do the strategic portfolio alignment with sustainability goals. I would say the integration of climate risk into credit risk models is becoming a regulatory and business imperative. Climate risk software solutions, just to put it in a very general term, play a pivotal role by providing data-driven insights, scenario modeling and compliance tools, enabling banks and leaders to make a more resilient credit decisioning in a climate uncertain world. If you really like to do a deep dive into any specific aspect either with regards to regulatory frameworks, case studies, specific software comparisons, we have a specific use case demos for you to just try it out first, and then we take this forward in terms of even if you want to do a very modular implementation. For example, you just want to do credit risk modeling integrated with climate risk scenarios, you can do that. Or if you can do a full suite of solution implementation using CRA.